Let's talk about depreciation. The first section you need to know about is Section 179. Section 179 is a tax rule that primarily benefits businesses by allowing them to deduct the cost of certain assets, like equipment, machinery, in the year they purchase them instead of spreading the deduction over several years. However, it's important to note that this rule doesn't generally apply to real estate investors in the same way it does to other businesses. Real estate investors typically use a different form of depreciation called straight line depreciation for their rental properties. This means you deduct a portion of the property's value each year over a set period, usually 27 and a half years for residential real estate and 39 years for commercial real estate. Section 179 is not used for real estate investments because it's designed for more tangible, movable assets like computers, vehicles, or equipment that you might use in your business operations. So in simple terms, Section 179 depreciation isn't something that real estate investors typically benefit from because it's geared towards other types of business assets and not real estate properties themselves. Now, mind you, real estate investors do utilize Section 179, but it's in other things within their real estate world. That said, in simple terms, Section 179 depreciation isn't really a big deal for real estate investors, but it is and it isn't. Real estate investors follow a different set of rules for depreciation that are specific to this industry. Think of depreciation schedules as a sort of financial roadmap for keeping track of how the value of certain assets goes down over time. That's what a depreciation schedule is. So here's an example. Imagine you run a business and you've bought things like computers, machinery, or vehicles. Now here's the deal. These things don't last forever. They wear out or become less valuable as time goes on. So to reflect this decrease in the value of those assets on your books, and for tax purposes, you create a depreciation schedule. And your CPA is going to keep that depreciation schedule because it has to be updated every year. Now, back to the depreciation schedules themselves. A depreciation schedule is like a plan that outlines how much of an asset's cost you can deduct each year over its useful life. It's a way to spread out the expense of buying these items, making your financial statements more accurate. Here's how it works. First, asset details. First, list all the details about the asset, like when you bought it, how much it cost, and what type of asset it is. Second, the useful life of that asset. You estimate how long this asset will be useful to your business. For instance, a computer might be useful for 5 years before it becomes outdated, and if you've bought an Apple lately, they plan for that obsolescence. So you're going to buy every few years. Depreciation method is the third thing you need to understand when it comes to this way of depreciating things. You have to choose a method for calculating how much of the asset's value decreases each year. There are different methods like straight line, makers, and for yearly deductions. Based on the method and the asset's cost, you figure out how much you can deduct each year. This helps you calculate your business's expenses and taxes more accurately. Now, the last step in all this depreciation talk is the tax benefits that come to you. Depreciation schedules aren't just for bookkeeping. They also affect your taxes, which is what this is about. By deducting these depreciation expenses from your income, you can lower your taxable income and in turn pay less in taxes. In simple terms, depreciation schedules are like financial plans that help businesses keep track of how their assets lose value over time. They're important for both accounting and tax purposes, and they make sure that businesses accurately represent the wear and tear of their assets on their financial statements. Plus, they can help businesses save some money on their taxes along the way, which is also beneficial. Now let's talk about makers. Makers is a system established by the U.S. tax code to determine how you can deduct the cost of certain assets for tax purposes over their useful life. It's a method used to calculate depreciation, which is the process of recognizing and accounting for the gradual decrease in the value of an asset over time. Here's how it works. The first step in Makers is asset classification. Makers categorizes assets into different classes based on their type and expected lifespan. For example, a computer might belong to a different class than a delivery truck because they have different lifespans. 2. What is the depreciation period of that asset? Each asset class has a predetermined number of years, known as the recovery period, over which you can deduct its cost for tax purposes. The recovery period is typically shorter than the actual lifespan of the asset because it reflects how quickly assets are expected to lose value due to wear and tear or obsolescence. The next step in Makers is depreciation methods. Makers provides two main methods for calculating depreciation: the double declining balance method and the straight line method. The double declining balance method allows you to deduct a larger portion of the asset's cost in the early years and a smaller portion in later years. The straight line method deducts an equal amount each year over the recovery period. So if it's 100 divided by 10, boom, 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 same amount every year. Now, there is what is called a half-year convention in Makers as well, and you need to understand it. You may not use it, but let's talk about it. In Makers, there's a half-year convention, which means that regardless of when you purchase an asset during the year, it's treated as if it was acquired in the middle of the year for depreciation purposes only. This simplifies calculations. Here's something else, and I think you want to pay attention to this. It's called bonus depreciation, and I will talk about this a lot more later on. In some cases, you may be eligible for bonus depreciation, which allows you to deduct a larger portion of an asset's cost in the first year of purchase. This incentive is often used to stimulate business investment. In this year, in 2024, it is 60%. And again, I'll talk about it later, but it's 60% this year. Now, last part of Makers is depreciation deductions. So by using Makers, businesses can spread out the cost of an asset over time, reducing their taxable income and lowering their tax liability. This helps businesses recover the money they invested in these assets. In a nutshell, Makers is a systematic way for businesses to account for their decrease in the value of their assets over time for tax purposes. It involves classifying assets, determining their useful life, choosing a depreciation method, and applying tax rules to calculate deductions that can lower the amount of taxes a business owes. Now, I promised you we talk about bonus depreciation, and that is section 168K. Let's talk about bonus depreciation.